Ole Hansen just said something that everyone needs to understand. The head of commodity strategy at Saxo Bank, one of the most respected voices in precious metals analysis, put it in one sentence. The precious metals sector has so far been the primary beneficiary of heightened U.S. attack concerns. Primary beneficiary, not secondary, not one among many, primary. And he said that before the strikes actually happened. Now, as of February 28, 2026, with U.S. and Israeli military operations actively hitting Iranian territory and Iran retaliating with missiles toward Israel and U.S. bases, we are watching in real time whether Hansen's assessment was correct. Gold is holding above $5,000, silver is at 91, and the most important detail that almost nobody is focusing on is the timeline. This is not a surgical strike that lasts 48 hours. Multiple sources, including NPR and Israeli officials, have described this as expected to last a few days with focus on Iran's missile program, but Trump and Netanyahu both used language that signals weeks, not days. Netanyahu said, "as long as needed." Trump said, "major combat operations." Those are not phrases used for brief, limited strikes. Let me show you why the weeks-long timeline matters more than the initial price spike, why silver specifically is positioned as the primary beneficiary, and why I believe the next 60 days will produce price action that makes the January highs look like the beginning, not the peak. Start with Hansen's credibility because his track record matters when evaluating his assessment. Ole Hansen has been Saxo Bank's head of commodity strategy for over 2 decades. He has covered every major commodity cycle, every Middle East conflict, every precious metals bull and bear market since the early 2000s. He is not a permabull. He is not a gold bug selling newsletters. He is a professional analyst whose job is to be right for institutional clients who are managing billions of dollars. When someone with that profile and that track record says precious metals are the primary beneficiary of attack concerns, that is not hype. That is professional assessment based on institutional money flows, positioning data, and correlation analysis. Now let me show you why Hansen specifically singled out precious metals over other asset classes that also move on geopolitical risk. Defense stocks are an obvious beneficiary of war. Lockheed Martin, Raytheon, Northrop Grumman, all of them see their stocks rise when military contracts increase. Energy stocks benefit from higher oil prices. Exxon, Chevron, BP, their revenues increase when oil goes from $60 to $70 to $80. Yet Hansen did not say defense stocks or energy stocks are the primary beneficiary. He said precious metals, and there is a specific reason why. Defense stocks and energy stocks benefit from war, but they are also vulnerable to it. If the war disrupts supply chains, if it causes economic recession, if it triggers financial market stress, defense and energy stocks can fall even while their revenues are rising because investors flee equities broadly during risk-off events. Precious metals, by contrast, are pure safe haven plays. They do not have earnings that can disappoint. They do not have supply chains that can be disrupted. They do not have management teams that can make bad decisions. They are physical stores of value that have held purchasing power for thousands of years. When everything else feels uncertain, gold and silver are where capital flows. Hansen's use of the phrase primary beneficiary also implies that precious metals are outperforming other safe havens. US Treasuries are traditionally the safe haven trade during crises. Flight to quality means buying 10-year Treasury bonds. But look at what happened when strikes began. The 10-year yield moved modestly but did not collapse. Treasury prices rose slightly, but the move was muted compared to the magnitude of the geopolitical shock. Why? Because U.S. debt is at $36 trillion, the deficit is over $2 trillion annually, and investors are questioning whether treasuries are still the safest asset or whether the sheer scale of U.S. fiscal imbalance makes them riskier than historically assumed. When the traditional safe haven is losing credibility, capital flows to the alternative safe haven, and the alternative is gold and silver. Now let me address why Hansen's assessment specifically highlights silver alongside gold, because that distinction matters. Gold is the classic war hedge. That relationship is well understood. When geopolitical risk rises, gold rises. But silver often gets overlooked in that framing because it is viewed primarily as an industrial metal. Half of silver demand comes from industrial uses, solar panels, electronics, EVs. When economic growth slows, industrial metals typically fall. Copper falls, aluminum falls. The logic is that less economic activity means less industrial demand. So why is silver, which is 50% industrial, rising alongside gold rather than falling like other industrial metals? The answer is that silver has dual demand. It has the monetary safe haven demand that gold has, and it has industrial demand that other metals have. During normal times, those two demand sources offset each other. When the economy is strong, industrial demand rises, but safe haven demand falls. When the economy is weak, safe haven demand rises, but industrial demand falls. But during a war that disrupts supply chains and threatens energy supplies, while also driving safe haven flows, both demand sources activate simultaneously. Safe haven buyers want silver as a store of value. Industrial users want silver to stockpile against supply chain disruptions. That dual demand activation is what makes silver the primary beneficiary, not just a secondary beneficiary alongside gold. Let me show you the specific mechanisms that are driving silver higher right now. First, the Shanghai premium at $9.38 confirmed that Eastern physical buyers value silver 11% above COMEX prices. That premium existed before war started. Now, with war active and supply chains at risk, Chinese industrial users who need silver for solar panel factories are not going to wait and hope. They are going to bid more aggressively to secure supply. That premium widens. Second, COMEX delivery stress from first notice day yesterday. March contracts representing hundreds of millions of ounces in paper claims face approximately 98 million ounces of registered physical. Elevated delivery demand continues the pattern from January and February. Now add war risk on top of existing stress. Industrial hedgers accelerate procurement. Delivery demand intensifies. The exchange is forced to raid SLV, raise margins, or cash settle. Any of those actions destroys confidence in paper silver and widens physical premiums. Third, oil above $70 and potentially heading toward 80 or 100 if Strait of Hormuz is threatened. Higher oil means higher mining costs. Marginal silver mines become uneconomic unless silver prices rise proportionally. Supply comes offline. The structural deficit that the Silver Institute confirmed at 67 million ounces widens to 100 million or more. Price has to rise to ration existing supply and incentivize higher cost production. Fourth, Samsung and Tesla securing direct mining supply through vertical integration. Every ounce locked into exclusive offtake agreements is one less ounce available to COMEX or spot markets. That trend accelerates when war makes supply chain reliability the top priority. All four of those mechanisms were in motion before war started. War does not create them. War accelerates them, and Hansen's assessment that precious metals are the primary beneficiary is grounded in the observation that gold and silver are the only asset class where all four tailwinds are operating simultaneously and compounding each other. Now let me address the timeline issue because this is where the weeks-long duration becomes critical. A surgical strike that lasts 24 to 48 hours produces a price spike followed by mean reversion. Investors buy the rumor of war, sell the fact of war, and prices return to pre-war levels within days. That is the pattern from limited operations like the June 2025 US strike on Iranian nuclear facilities. Price spiked briefly, then normalized. But a weeks-long campaign is different. It sustains the war premium. It validates the safe haven demand. It gives industrial users time to reassess supply chains and increase stockpiling. And most importantly, it creates the conditions where geopolitical risk premium becomes embedded in pricing rather than being a temporary spike. Here's the evidence that this is weeks, not days. Netanyahu said, "as long as needed," when describing the operation's duration. That is open-ended language. It does not commit to a timeline. It signals that the campaign continues until objectives are achieved, regardless of how long that takes. Trump said, "major combat operations," which is terminology used for sustained military campaigns, not brief strikes. The 48-hour state of emergency declared in Israel suggests they are preparing for a sustained response period, not an immediate all clear. And the person briefed on the operation who told NPR it was expected to last a few days also specified the focus is targeting Iran's missile program. Iran has hundreds of missile sites dispersed across the country. Systematically targeting that infrastructure takes time. It is not a one-night operation. Iran's response also suggests this will not be brief. They launched retaliatory missiles toward Israel within hours. They promised crushing retaliation. They said all U.S. and Israeli assets in the Middle East are legitimate targets with no red lines. That language does not describe a country planning a symbolic retaliation and then standing down. That describes a country preparing for sustained conflict. And if Iran retaliates with attacks on U.S. bases or oil infrastructure, the U.S. will respond to those attacks, which triggers further Iranian retaliation, and the cycle extends. That escalation dynamic is what turns a limited strike into a weeks-long campaign. Here is what weeks-long duration does to precious metals pricing. Day 1, war premium spikes. Gold and silver jump on initial headlines. Day 3 to 7, some profit-taking as traders assess whether escalation continues. Day 7 to 14, if conflict is still active and escalation is occurring, the war premium reestablishes at a higher level than day 1 because markets realize this is sustained, not temporary. Day 14 to 30, if oil is above 75 and supply chain concerns are validated by actual disruptions, industrial hedging accelerates and the premium widens further. Day 30 to 60, if COMEX delivery stress compounds with war-driven supply chain risk, physical premiums gap wider and paper markets lose credibility. That timeline, if it plays out as I am projecting, takes us into late March and early April. By then, we will have 2 full months of March COMEX delivery data. We will see whether Samsung-style direct mining deals multiplied. We will see whether Shanghai premium widened or compressed. We will see whether oil stayed elevated or normalized. All of that data arrives while war is still active, and if all of that data confirms the thesis, tightening physical supply, elevated industrial demand, sustained war premium, then silver does not return to 91. Silver moves to 100, 110, 120, or higher because the combination of tailwinds has no offset. Let me also show you what happened to gold and silver during previous weeks-long Middle East conflicts because the pattern is instructive. During the 1990 to 1991 Gulf War, gold rose from around $380 before the August 1990 Iraqi invasion of Kuwait to $410 by January 1991 when combat operations began. It did not spike to 500 or 600. It rose steadily as the conflict unfolded over months and held those gains. During the 2003 Iraq War, gold rose from around $320 in late 2002 to $380 by March 2003 when the invasion began, then continued rising to $400 as the insurgency developed. The pattern is not a dramatic spike and crash. It is a steady elevation that persists as long as conflict is active. Silver historically moves with more leverage than gold during these periods. In the 6 months surrounding the 1990 Gulf War, silver rose from around $4 to $5.50, a 38% gain compared to gold's 8%. In 2003, silver rose from $4.50 to $5.30, while gold rose 20%. The gold-silver ratio compressed during both conflicts as silver outperformed. If that pattern repeats in 2026, with gold above 5,000 and silver at 91, a compression in the ratio similar to 2003 would take silver toward 110 or higher, even if gold only moves modestly. And if gold moves toward JP Morgan's 5,400 target or higher, silver at 110 would be conservative. Now let me address Hansen's phrase, heightened U.S. attack concerns, because he said that before strikes actually happened. His assessment was that precious metals were the primary beneficiary of attack concerns, meaning the anticipation of war. Now that war is actual, not anticipated. Does his thesis strengthen or weaken? It strengthens, because the uncertainty premium that existed when war was possible but not confirmed is replaced by the reality premium of war actually happening. Uncertainty creates volatility. Reality creates sustained positioning. Institutional investors who were hedging the possibility of war now have to hedge the reality of war. That is a larger capital allocation, not a smaller one. Here is my optimistic synthesis. Hansen called precious metals the primary beneficiary before war started. His assessment is being validated in real time. Gold above 5,000 is not a temporary spike. It is a sustained repricing driven by war premium, safe haven demand, central bank buying, and fiscal concerns all operating together. Silver at 91 with dual demand from safe haven buyers and industrial hedgers is not expensive. It is undervalued relative to where supply-demand fundamentals require it to be when you factor in COMEX stress, Shanghai premium, oil-driven mining cost increases, and direct offtake deals removing supply. The weeks-long timeline matters because it gives all of these forces time to compound. This is not a one-day news event. This is a multi-week campaign that keeps war premium active, keeps industrial hedgers engaged, keeps COMEX delivery pressure building, and keeps physical premiums elevated. By the time we reach late March, we will have 8 weeks of continuous data showing that physical demand exceeds paper supply, that Eastern buyers pay materially above COMEX prices, that industrial users are bypassing exchanges, and that war sustains the premium rather than creating a temporary spike. Stay positioned. Trust Hansen's assessment. He is one of the best in the business and his track record speaks for itself. Precious metals are the primary beneficiary. Silver specifically has the dual demand that gold lacks. The weeks-long timeline supports sustained price increases, not mean reversion, and the convergence of war, COMEX stress, Shanghai premium, and oil risk creates the perfect storm for physical silver to reprice structurally higher over the next 60 days.